Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Keith Dennerstein, Director of Guidance Product Management at TD Ameritrade. In today's podcast, we have an interesting topic for you as we're looking at trends among generations when it comes to their investments. In particular, we look at what sets millennial investors apart from their baby boomer counterparts, where investors have been focused since the election, and some surprising trends on the ETF front too. So make sure to stay tuned for that right after this. All right, Keith, first off, thanks for joining us. To kick things off, I wanted to focus on the generational trends you've been seeing in the market for 2016. Have certain generations been focused on specific ETFs more than others?
Yeah. Well, of course, we've seen continuation of some of the trends that have really become evident in the past few years and some new trends that have been emerging as the year has gone by. Typically, what we see is millennials more active in equity-based funds, particularly compared to some of the older generations, as might be expected when you think about boomers or people who are closer to retirement. A lot more of their holdings when it comes to ETFs comparatively are in taxable bond funds and what we would consider more of a safer income fund, whereas when we look at millennials, we see them going a little further down the risk spectrum, or a little further up the risk spectrum, I should say, in terms of where they get their income and yield from. So millennials might be looking at REITs or dividend equity funds to get some of their income and yields, whereas investors get older, they move a little bit more into some of the conservative sources of income that you might expect. Another thing that we generally see as people age, as you move up from millennials to Gen X to boomers, gold in particular becomes a larger part of people's holdings, and it's certainly been interesting this year, as obviously gold has had its ups and downs, particularly since the election. You see, or we have seen, millennials cutting back on their commodity exposure, and a lot of that commodity exposure is through gold, and boomers have been sort of holding firm in terms of their exposure to the precious metals. For them, we imagine that gold is more of a staple, something that they're going to hold through thick and thin, and the numbers have really borne that out over the course of the past few months.
Interesting, yeah. As a millennial myself, I guess I don't feel like gold has the same appeal that it might have for older generations, but are you seeing any similar trends with the gold mining space, sort of the equity side of this coin?
Gold mining is, particularly with ETFs, it's a much smaller portion of commodity and commodity-linked exposure as far as ETFs are concerned. So I would take any swings in exposure in those areas with a bit more of a grain of salt, but definitely an extension of what I was saying before. But in particular, when you look at boomers, and I mentioned their gold exposure, it is typically to the physical commodity or ETFs that are linked to the commodity, and less so through the miners who might be a bit more volatile. And as we move to the millennial generation, where a smaller portion of their holdings are in commodities and gold anyway, the same applies with gold miners. When we look at millennials in particular, their largest holdings are going to be those broad market indices that give them exposure to equities of all sorts. So when they're looking at equity exposure, they're really doing it on a broad market basis, and as they get finer and finer into particular sectors, the holdings diminish rather quickly. So when we look at millennials, we see broad market U.S., broad market international really being the main holdings. And when we get to sector exposure, that's really something that we see those as attracting more interest from clients as they age. So whereas millennials might have a little bit less sector exposure, as we get to Gen X and then to boomers, the sector exposure generally increases.
Do you feel like part of this might be a cost issue? Maybe the millennials, and we've heard a lot about a focus on lower costs for younger generation. Maybe the broader market funds, generally speaking, have a much lower expense ratio. Do you think this is part of the reason we see this shift among the generations?
Yeah, I certainly think that could be one of the major causes when you think of ways that millennials are getting their exposure. Historically here at TD Ameritrade, it was through individual ETFs, but we've recently launched a robo-advisor called Essential Portfolios, and a large part of that is in response to what we've seen and the fact that younger investors are highly cost conscious. And when they do want to have exposure to ETFs, whether it's through an automated investing service like our Essential Portfolios or through individual ETFs, they're looking at a way that they can get broad market exposure at a low cost. Obviously, when you have a managed product, it allows for rebalancing, and that sort of takes a burden off of the shoulders of the individual investor. But whether it's through a product like that or through the individual ETFs, we definitely think that low-cost ETFs and low-cost products are something that particularly millennials are attracted to.
Now, one other thing I did want to ask you is we often talk about this home country bias issue of investors primarily investing in their domestic market. Do you see any shifts among generations? Do maybe millennials have more foreign exposure, or do boomers, or is there no real rhyme or reason to the trends here?
So there's a few interesting things that we've noticed. One is that it seems as though international exposure is higher, at least higher relatively amongst the holdings of each generation. The international exposure is higher up on their list, so more heavily weighted to those international equities when you look at millennials in particular, but also Gen X compared with boomers, who are a little less weighted in terms of international equity exposure. Now, the one thing that is interesting, and any rationale that I would be able to come up with would be more of conjecture, but Gen X, in terms of their international exposure, gets a larger proportion of it through emerging markets. Now, I could guess whether some of that might have to do with the rise of China over the past 20 to 30 years and the time when that generation was coming of age, but it's definitely something that's interesting and bears some looking into, and something that we've been researching and trying to get to the core of here at TD Ameritrade.
Yeah, that's interesting that it we sort of see that bubble in the middle of the generations for the exposure to China and emerging markets. Are you seeing anything similar for Europe or any of the other regions of the world?
Nothing similar that stands out in such a dramatic way to us. When we look at international, we usually typically look at developed versus emerging as opposed to individual regions or countries. So the developed versus emerging dichotomy really makes itself a bit more clear when we look at Gen X compared to some of the other generations. But when we step outside of that, there's really nothing that catches our eye in such a standout way.
Sure. And maybe let's talk briefly about some of the top 10 holdings by generation. Are you surprised by anything you see on the list of, hey, millennials are more focused on these areas, or, they're less focused on here, and I would have thought it'd be something different? Any real shockers to you on that list?
Well, this is one where I'm happy to say that this really does fit the general thesis that we have, that I think the larger financial audience might have, which is that millennials, as I mentioned before, when they look for yield, they might look to something that's a bit further down the risk spectrum in terms of REITs or dividend equities, as opposed to the older generations where you see more and more of a shift to bonds, and particularly with the older generation, unfortunately, given the recent market circumstances, municipal bonds. So in this sense, it is what we would have expected. Recently has been playing out in favor of the holdings that millennials have been having or have been holding, but definitely fits in line with the general thesis that both we and I would imagine the broader audience would have as well. One of the other interesting things is the bend or the tilt of equity holdings, where the equity funds held by millennials are more heavily weighted toward the growth end of the spectrum, whereas boomers are more focused on value. And, of course, as is typically the case, Gen X is somewhere in the middle with more of a balance between the growth and the value. But, again, fits well within that thesis of millennials being a bit less risk averse and a bit more willing to take on risk in their holdings. And then as we get closer to Gen X, scaling back on the risk a little bit, and particularly when you think of the position that a lot of those investors are in now, coming out of what was a pretty traumatic 2008 to 2009, building back up their retirement savings as they get closer and closer to retirement, it would make sense, particularly given the market move that we've had over the past few years, that they would scale back and be in some of the more conservative types of funds.
Yeah, definitely. And you briefly mentioned some of the recent trends in the market, and in particular, you highlighted muni bonds. I think that's particularly interesting just because in a note that you guys released back before the election, munis were one of the more popular areas for boomers to focus their ETF holdings in on. But, this has obviously been a really weak area of the market since the election. So have you seen a lot of shifts since the election in terms of assets and funds people have been focused on? Maybe you can talk a little bit about some of the biggest gainers and losers in this regard.
Yeah, so I can definitely speak to that. I can tell you that boomers have moved out of municipal funds to a greater extent than some of the younger generation. And as I mentioned, unfortunately, those funds have been performing rather poorly, and it does seem as though boomers are taking the losses and moving in a different direction. So that's something that we have identified and we've noticed as something that's a generational differentiator. But in general, we've seen sort of on a larger scale across all age audiences and all age categories, people actually moving a greater degree of their assets into volatility-based funds. So that's something that's interesting, particularly given the large run-up that we've seen in the past month plus since the election. The fact that with volatility becoming so inexpensive, people are beginning to allocate a bit more of their holdings to that shows that they're preparing for a potential pullback in some of the large move that we've seen. At the same time, though, we have seen increases in net flows into industrial funds and into financial-based ETFs. So some of the sectors that have been the stronger performers have attracted more of the assets from our broader client base.
Okay. So when you talk about volatility funds, you're referring to products like VXX and the like, correct?
Yeah, without getting into any of the individual ETFs.
Sure, but just as an example,
funds that will track the VIX.
Okay. And have you seen any other of those safer type ETF or, ones that are preparing for more volatile situations? Have those been of interest to any investors besides this whole class of volatility linked funds?
Well, I think the way it looks to us is that the volatility funds are really the way that people have been getting more of their protection, if you will. Some of the generally safer or what we might consider to be safer funds have actually seen outflows as they've been a little out of favor as the market has been rallying. So when we look at things like defensive or consumer defensive funds, they've seen relatively large outflows compared to some of the other categories. So people have been, along with the market, rotating out of things that they had been in the past that might have been a bit more defensive and generally shifting those funds over to some of the sectors that have been more high performers over the past month. But then at the same time, looking more to the volatility-based ETFs as a way to protect themselves against a potential pullback.
Yeah, and you briefly mentioned before that investors were moving more into industrial and financial-focused products. Mm-hmm. I just want to ask, are they mostly using the broader funds that target the whole sector, or are they looking more below the surface at, say, like a regional bank product or, something more on the industry level?
So that's one where I'll have to say I don't have the individual fund breakdowns in front of me. I have sort of the top holdings. When we get down to the real granular level of whether it's the bulge bracket banks or more of the regional banks, those really are a little bit further down. The larger holdings would be the broad sector. So when you think of the broad industrials, the broad financial ETFs, those are the major holdings. Once we get below that, it really is a smaller base of investors. So while there might be larger percentage moves, the actual dollars are a bit less, and I don't have those figures in front of me right now.
Sure. Now, sort of switching gears here, OPEC was obviously in the news as of late, thanks to their decision. Big move in the oil market as of late. Have you seen a similar shift in oil ETFs? And has the focus really been more on the commodity or the underlying equities or even countries that have sort of a tie to the oil market?
Yeah, so when we think of commodity-based ETFs, we really look at it on a larger scale. As I mentioned with some of the sector ETFs, we look at it the same way, where we'll look at general sector exposure before we really dig into some of the granular details of which funds within that sector might be attracting the flows. And when you do look at it on a larger scale and you look at just general energy-based ETFs, we've actually seen outflows since the OPEC meeting. And if you try to tie a hypothesis to that, it might be there was obviously a huge squeeze and a big move in oil immediately after. So there might have been some profit taking from our retail investors who, saw that big move. Many of them might have been hanging on and waiting for that. And once we did get that, they pulled back a bit on their exposure. And I know I mentioned that we don't get too granular, but one of the details that was interesting to us is that U.S.-based oil and resource funds have actually seen an increase in AUM, or I should say inflows, since the OPEC decision. So the combination of OPEC plus some of the things we've been hearing about Trump and his administration and their potential possibility to be open to more oil exploration seems to be shifting retail investors to domestic-based oil and oil-based funds as opposed to some of the broader or international-based ones.
Interesting. I wouldn't have thought that would be the case. Now, I'm not sure if you can answer this one, but we're hoping to maybe discuss some of the trends in the overall ETF market that you've noticed. One of the bigger things as of late has been a lot of these smaller tech ETFs, but then also this idea of smart beta funds that go beyond just looking at market cap and try and weight products by a certain factor, say revenue or a combination of other things. Are you seeing a big level of interest in these products as the year has gone on, or is this, is it kind of just so interest in some of these names?
Yeah, those kinds of funds have been growing in interest when you think of some of the more nuanced funds like smart beta funds that have been introduced and gaining popularity. The same holds among our retail audience as well over the course of the past year. So I would definitely say that those have been attracting an increasing amount of interest. Obviously, they go a step beyond your plain vanilla index fund, and there have been more and more fund providers creating their own twists on different ways to weight their indices other than by market cap. So that sort of thing has become more and more attractive. Whether that will be something that lasts or is just a passing trend, time will really bear out. But in the interim, whether it's the publicity around them, the performance that they've seen, or just the market environment that we've been in, there has been some interest and a growing interest among our clients for those types of funds.
Okay. And as a last question, this is something I've always wondered, but would you say the commission-free program that TD Ameritrade has tends to drive investors into certain ETFs over others, or do you not really see that bearing out in the flows?
Yeah, so the commission-free program that we offer does, we're proud of the funds that are in it, in that we do have a lot of the most well-known and most highly traded, most liquid funds in the market in our commission-free program. So those funds would attract interest regardless of whether they were commission-free or not, but we definitely do see higher activity and higher levels of investment in the funds that are on our commission-free list. We do as good as we can to spread the word about it and to let our clients know about some of the funds that we have and the benefits of them. We have an entire ETF knowledge center that surrounds that commission-free list as well. So even if someone were to become a TD Ameritrade client and not know all that much about the world of investing or about ETFs, we try to educate them about what's out there. We educate them about our commission-free list. And what we have seen is that people who do enroll in our commission-free list and begin trading those funds then become some of our best clients, whether it's the funds themselves that are on that list or then moving into other securities that might not be on the list. It's a good way for them to learn, to get that exposure, and then to really become some of our most dedicated and valued clients.
Interesting. Okay. Oh, great, Keith. Thanks for coming on. I think this is a really interesting look at some of the trends in the ETF market as of late. So great having you.
I appreciate it. Thank you very much.
All right, everyone. That was Keith Dennerstein, Director of Guidance Product Management at TD Ameritrade. We'll have to have him back on in the future to discuss some new trends and see where investors are putting their money to start 2017 too. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.